Hello, ladies and gentlemen. I'm Joseph Novichkov, Senior Trading Manager with GDM. Today's outlook, we start as usual with Asian equities, slightly higher on Thursday morning after the Greek Parliament voted in favor of a new bailout plan, but Chinese markets, the volatility remained a worry. China's benchmark Shanghai Composite tanked as much as 2% before erasing losses in late morning trade. The index closed down 3% on Wednesday, despite strong second quarter gross domestic product data, after, of course, snapping a three-day rally on Thursday. Japan's benchmark Nikkei 225 index climbed for a fourth day, ending at a new three-week high as investors cheered a weaker currency. The yen, as we speak, weakened to a new three-week low of 123.97 per dollar. Of course, that was overnight and hovered near that level in the Asian session. Lawmakers in Athens passed strict austerity measures needed to secure a debt deal from its creditors early Thursday morning, local time, 2 hours after the official deadline. However, politicians from within Prime Minister Alexis Tsipras' ruling Syriza party opposed the conditions outlined in Monday's deal, which of course induced tax increase and spending cuts, sparking concerns of internal political strife. The vote comes ahead of Monday's payment to the European Central Bank, and of course, attention now falls on the ECB's rates decision later today, with President Mario Draghi is likely to face questions on a decision on the emergency liquidity assistance for Greece. While we're at it, looking at the euro, it edged lower on Thursday after Greece's parliament approved the austerity plan demanded by its lenders. The euro briefly ticked higher on the Greek news, but later sagged back down and touched a six-week low at 1.0912. At one point, the single currency was last traded at 1.0930, down 0.2% on the day. Also, we're paying attention to the US dollar that it firmed as the Federal Reserve chief did not waver from her viewing that a rate hike was on cards this year. In the US Federal Reserve, Chair Janet Yellen kicked off her two-day testimony before Congress on Wednesday, saying that a decision to hike rates would not mean the economy was in trouble. She, of course, reaffirmed last Friday's statement that the central bank is on pace to rise rates this year if the economy evolves as expected. In the commodity sector, we're looking at gold right now near its lowest level since March on Thursday, after Federal Reserve Chair Janet Yellen reiterated that a U.S. interest rate increase is likely this year, buoying the dollar and balance expense. Yellen said that U.S. Central Bank remains on course to raise interest rates this year, with labor markets expected to steadily improve, and of course turmoil abroad unlikely to throw the U.S. economy off track. Gold was off 0.3% at 1145.85 an ounce in Asia trades, close to Wednesday's through of 1143.43. That's its weakest since March 17. A potential U.S. rate hike has been discussed in financial markets as early as 2013, and of course gold has already fallen as a consequence. This reinforces our view that gold prices are likely to stay above 1100 mark an ounce, although they may remain weak due to momentum selling in near term. Oil prices in the energy sector rose slightly on Thursday morning after data showed that the U.S. crude inventories dropped and refineries demand was high, although the outlook remains for cheap oil as oversupply persists. U.S. crude inventories fell 4.3 million barrels last week, according to the Energy Information Administration, as refineries boosted the output to record level. Front month, U.S. crude futures were trading at $51.94 per barrel. Throughout the Asian session, that is 53% up from their latest settlement, and of course, $1.9 down since yesterday's peak. In the calendar today, important events is coming up the consumer price index for the Eurozone at 9, along with that, the trade balance and ECB's interest rate decision. And of course, in the afternoon at 14, Fed's Chair Yellen will testify before the Congress. That's all for today. Thanks a lot for joining us. See you next time.